Welcome back to another episode of Connor's Corner. This is episode 3, and we will be talking about Roth conversions. All right, this is a huge portion to our year-end tax planning that I'm always doing for clients. Specifically, this will really focus, I should say, a majority of clients between ages retirement, so 65, let's generalize it, to 73. Also, there are some caveats if we're younger. These Roth conversions can be very, very impactful to you as well. All right, so a wide margin of people that can use this strategy. We're going to talk about exactly what is a Roth conversion, some strategic considerations when doing them, all right, and then common mistakes that I see all the time that definitely annoy me that I will try to allow you to sidestep. The definition, all right, is on screen, but I'm going to summarize it here for you. So if I have money in a traditional IRA, 401k, pension sharing plan, something like that, okay, I'm going to in turn move that money to a Roth. In the year that I do that, the amount will go on that year's tax return, okay, and then I will allow that money to then grow tax-free from there. How it works, all right, let's give a little situation here for you. So we have a John who's 40 years old, has $10,000 in a rollover IRA. He would like to transfer the full balance to a Roth, but he's already contributed to this year's Roth through his contribution amount of a max of $7,000. Can he convert the full $10,000, and what are his steps? All right, the answer is yes. Okay, he can do this. So right now he has a Roth IRA balance, let's say, of $7,000, and he's got that rollover of $10,000. What he has to do is file a quick form with wherever that rollover is held. Okay, let's imagine Fidelity, Charles Schwab, something like that. He files a form with them saying, hey, I want to convert the full $10,000 to my Roth. With that, his Roth balance, of course, increases by the $10,000. He then has a $0 balance on his rollover IRA, and he will receive a 1099-R at the end of the year to give to his accountant when he does his taxes. That will say, hey, my income went up $10,000 this year due to this Roth conversion. Highlighted on the screen, all right? Clients ask me this all the time. You can always do a Roth conversion and contribution in the same year, okay? These are two completely separate activities for the account, so we can always fund, max the Roth out, and do whatever amount of a Roth conversion we so choose. Some key features of these Roth conversions, all right? As mentioned in the last video, when it comes to a Roth, we, of course, get tax-free growth rate later and tax-free withdrawals, all right? So Roth is king. Roth is the king, all right? So Roth assets, tax-free. Sooner it goes into a Roth, the less Uncle Sam can take later, okay? So essentially what we're doing here is we are locking in an amount that will be taxed and allowing the rest to grow tax-free. All right. Then, of course, we have tax-free withdrawals. We're going to talk about the 5-year rule next slide here. Okay. That is a very, very important caveat to Roth conversions. Lastly, this is an irreversible decision. Irreversible. Once we say $10,000 is being converted, I cannot go back and say, whoops, I made a mistake. I want to keep that $10,000 in my rollover. Okay. Very, very key. Unlike, remember, a contribution to a Roth, I can put it in and take it back out immediately. Okay. Penalty-free, tax-free. I'm taking my basis. Roth conversion has special things, which we'll talk about in this 5-year rule. So once you do it, we cannot go back. When is the right time? All right. And this is what I was talking about on the first slide. All right. So if we are young, right, we're still working, we're 25, we're 35, okay, and we we move jobs and we have an old 401k, and let's say it's got that 10,000, 15,000, okay? We have a long time horizon before we are going to distribute it in retirement. It is probably smart to do a Roth conversion, maybe a little each year, okay, to convert it to a Roth and allow that to grow tax-free because we have a lot of compounding years left. All right. You don't have to do the full amount. You can section it out. Okay. Also, because of this, usually we're at the starter phase of our jobs or early in our career. So we're going to have lower income years than we're in our peak earning years, which is usually somewhere from 45 to 60 is usually the peak earning years. So low income years are great years to do a Roth conversion. Another example is you take a sabbatical at work, or you're laid off for a year, something of that. If you've got cash on the side, we want to do a conversion in those low income years. Okay. And then for the clients that are retired, we have a great time period. Let's use 65 to 73. Those are the best years to do Roth conversions. Okay. And I say that because if your current advisor is not talking to you about Roth conversions and you are retired, you need to A, bring it up, or B, they're doing a bad job. Okay. I cannot state that enough. I see it all the time with clients when I do their taxes and I don't do their investments, and I go, why aren't you doing Roth conversions? They a year ago retired, they were making $100,000, they were in a higher tax bracket. The next year they're just on Social Security. You need to be doing Roth conversions or having the conversation and making the decision if you want to do them. Okay. This is also a huge thing for estate planning, right? Looking at it from a household, you're going to pass these assets on eventually. We'll talk about that in a little bit. And also anytime, any age really, if there is a big market downturn, that's the time to do a conversion, right? If the market just dropped 20%, well, bang, we can convert it then and then let it, when the market hopefully comes back, whenever it does, it will come back on the tax-free side, okay? So those are some key time triggering moments to have the conversation about these Roth conversions. Now, the five-year rule that I spoke about, okay? So each conversion that we do, it's going to increase your basis just as a contribution to a Roth increases your basis, right? So if I convert 90,000, my basis will go up by 90,000, and I'm going to pay the $90,000 in the year of conversion. I think everyone pretty much understands that. I talk about the basis in my last video, so if you didn't catch that one, go over and check it out. Okay, each conversion has a 5-year period. All right, now this is where it starts to get a little tricky, so hang in there with me. All right. If you are 59 and a half or older and distribute before the 5 years, okay, there will be no 10% early withdrawal penalty, but the earnings will be taxable. Okay, so let's use what we just said. We converted 90,000. We did it when we were age 60. At age 63, we go, hey, we want to distribute our full Roth out. Your basis is 90,000. 3 years from now, the account is worth 100,000. You have $10,000 in gain. That $10,000, because you did not wait 5 years, is going to go on your tax return as taxable income, and you're going to pay at whatever tax bracket you were in. Okay? If I am 59 and younger, I'm going to pay, and I do exactly the same thing, I'm going to pay a 10% early withdrawal on the entire amount. Additionally, the earnings are taxed. Okay? So I like to always tell clients, if you do a Roth conversion, you are not going to touch it for 5 years. Okay? So we need to have other money to live off of and allow this money to grow tax-free. Or if we're over 59 and a half, we are allowed to go and touch it. We just can't touch the earnings. Okay? And how does the IRS know what is what, right? We've contributed along the road. We've converted along the road. We've had earnings along the road. How do they know? The IRS looks at it and goes, contributions are the first portion to come out. Conversions are the second portion to come out, and earnings are the third portion. So while it might seem that, hey, I've done these conversions for multiple years, I've kind of contributed throughout the years, more than likely you won't have a taxable implication. Okay, but that's the job of your financial person, your accountant, to know if you will. Okay. Now, this is always fun here. I always like to say the methodology, all right? And when people talk about Roth conversions, I always laugh that it somehow comes up in conversation around the holidays, usually at the table with a relative, right? Hey, my guy's doing this. Are you doing that? So hopefully this Thanksgiving, if it does come up, you can say, yes, I've watched a video on it, or I've talked to my person. And we love financial talks over politics or something like that. But anyway, so methodology here, right? We are always looking to maximize a lower tax bracket. That is, at the end of the day, the number one goal, right? And so to piece it out just to you, where I talk about this, I'm actually going to hop down the second section there before I talk about the first. So why RMD age? All right. So if I know I'm just doing Social Security from 65 to 73 and have no other income coming in, and I'm not forced to take my RMD yet, that allows us to be in this lower tax bracket in here, probably somewhere. Okay. But then if I'm forced to take an RMD of, let's say, 55,000 and I'm single, well, I'm instantly going to be thrown into this higher bracket. And even if I'm joint and I have Social Security and maybe a couple other income streams, I'm going to be thrown in a higher bracket. That could be a 10% savings. So each year, if you imagine if I did 10,000 per year, I could drop that RMD down, right, and keep it under and keep it in the 12% threshold. All right, you're going to pay the tax eventually. So let's do it most tax efficiently, right? The next portion that I always bring up, and this is a hard one to talk about, all right, is legacy planning, right? So remember here that if, regardless of how much money is in the account and you take it all on your tax return, or when you pass away and you give it to your beneficiaries, the money is going to come out and it is going to be taxed, okay? And so I have a lot of older clients who are in this lower 10 to 12% tax bracket, right? And their kids are 30 years younger than them, right? And so they have, let's say I have a 75-year-old client, their kid's 45, probably in the peak earning stage. Well, the child is somewhere maybe in the 22 to 24% bracket. So remember, if mom and dad pass away and they're in the 10 and 12% bracket, but beneficiaries are in the 22 to 24% bracket, well, the beneficiaries are going to give Uncle Sam another 10% that you could have paid. Okay. And so when I say that, of course it's going on your tax return, you're paying the tax. I've had clients' kids pay the amount of tax for their parents because they know that they're going to get the assets 10, 15, 20 years from now, whatever the day is. And once it goes into a Roth, remember, the beneficiary does not pay tax on that either. Okay. So this is a huge plan when we look at legacy planning. Is not only are we looking at your tax return, we are also looking at, hey, I'm going to pass assets to my children. I don't want them paying tax. All right. And so you can set up a way to have the kids tell them the amount. You can, of course, pay it for them, whatever the case is. We want as much money in a Roth as possible. It's the best for the family. And so when I'm doing financial planning, I'm not just looking at it from the parent's perspective. If the parent is taking into account and wants to pass assets on to the kids, I am always taking into account what are the kids doing? What are their tax brackets, right? Doing a holistic approach to the full family legacy planning. Okay, so some common mistakes that I have here. One, paying taxes. All right, this is a huge, huge thing that I see clients get incorrect. Think about it this way. Especially when I'm 65, right? Once I turn 65, the only way to fund a Roth is if you have earned income. Social Security does not count. Distributions from retirement do not count. So once I retire, I can no longer fund a Roth. Okay, so I'm done contributing to it. So the only way to put money into it is through Roth conversions. Doing that, I do not want to pay tax out of the conversion amount. Okay, so what you could potentially do, and again, I do not recommend this. If I did $10,000 conversion and I'm in the 10% tax bracket, I could withhold that $1,000 in tax on the conversion, in turn putting $9,000 into my Roth. Well, I always want to pay out of my pocket. I want to pay out of cash, okay? Because cash could have things according that are doing something that have tax implications, right? If I have money in the bank and I'm earning interest, that interest is going on my tax return. Okay, so I want to always move money up the ladder that we talked about last video to the best area of taxation. So if I can only I'm no longer allowed to contribute to a Roth, I want to make sure that every dollar I have the potential to put into a Roth, I put in there. Okay, and that is why we do not withhold tax on the conversion. The last is consulting a professional. Okay, I'm going to talk about the worst one that I always see is Medicare, which needs its own slide. So we'll talk about that next. But Consulting a professional is huge. There are so many different things that go into a Roth conversion. Of course, looking at your bracket, that's changing. With the new big, beautiful bill, we get higher standard deduction on some of our Social Security distributions. I'm taking into account, as I said before, legacy planning. What should we do anything? Well, are your kid's a doctor? Well, he's in a higher tax bracket. So, let's make sure that you're maxing yours out, right? There's so many different little variables that can go in that you're probably not aware of. So consulting someone, throwing it on a tax return, doing a planner ensures that you're not missing something and causing future headaches for yourself. Of which the biggest one that I always see, the most common mistake, okay, is Medicare. All right, so if you're 63 and older and are going to start utilizing Medicare at 65, no, Medicare has a 2-year look back. Why? Doesn't make much sense to me, okay? So right now, our 2025 income is going to affect Medicare in 2027, okay? They have what I like to call is the hard line, okay? It's called above the tax is how they come up with your AGI, okay? If you are $1 over that hard line, they will throw you into the next bracket. Okay, and so instead of having Medicare premiums at $185 a month, they're going to charge you an extra $60, $80, $100 a month on top of that. All right, so we could charge ourselves $1,200 a year because we didn't do the correct planning, and that's why it's important to get a professional involved who can run the data, the software. Okay, so what does this mean, right? Income tax calculations, all right, versus Medicare calculations. So in income taxes, we all probably know. I'm going to take my income and then I'm going to deduct out standard deduction or the itemized side, and that's going to then give me my taxable income. Okay, so if I'm looking at the tax bracket, right, and I go, hey, I'm married filing joint, I'm in the 12%, we made $96,000. I actually could do roughly a $30,000 Roth conversion and still max out your 12% bracket because I'm going to be able to take your income and subtract out that standard deduction. Okay. On the Medicare side, we do not get that standard deduction. That's why I say it's above the line or the hard line. Okay. So if we look here, if we're single, and to use that exact number, and we go, hey, let's do a $30,000 conversion, and we throw ourselves over into $110,001 of income, we are then paying an extra 1.4%, okay, or 1.5 or 1.4 times the $185. And this is where someone who goes, oh, I want to do these conversions to help out my family or this or that and not hurt myself too much. Well, we could throw off our Medicare premiums and charge you an extra $1,200 a year. That's a big deal for someone who is on a fixed income in retirement. Okay, so very, very important to take into account those Medicare premiums. All right, and this is the last one that I talked about when we talked about legacy planning. All right, to put it in perspective here, if our case study, right, as I said, so our parents are in a lower tax bracket, they're in the 15% total, beneficiaries in 28%. We can shift those assets, right, by the parents doing the Roth conversion. If we look at this long term and we did, a full, what do we have for 150? We did $1 million we had $1 million in our 401k. Okay, 15% of that is going to be $150,000 in tax, right? The kids are going to pay $280,000 in tax. That's $130,000 in taxes paid to Uncle Sam that your children don't get to put in their pocket, right? So we are talking huge, huge things here. And this is why it's important to coordinate with a professional, have your kids involved in your legacy planning, especially as we get older. So these Roth conversions are the number one strategy that I see missed and also that I'm implementing for clients to make sure that we're not only taking advantage of their brackets, but aren't throwing their kids or looking at the family and throwing the kids in the higher tax bracket too. Okay. Pretty simple one. Wanted to give Roth conversions are that important. They deserve their own video. Next month, I'm going to talk about year-end tax planning, some other different strategies. And down below, we'll have all of our other socials highlighted that you can give a follow, give a like, give a rating on or whatever. So we got our Facebook, YouTube, and LinkedIn page. All right. As always, thank you so much for watching. Disclosure there at the bottom. make sure that you consult someone before you do something. All right. You need to run the projections and make sure that you are actually doing the correct numbers. All right. Have a great Thanksgiving. We'll tune in after then. All right. Bye.